What if there was a way to invest in blue-chip stocks without having to pay the full share price? Sounds intriguing? Let me introduce you to the concept of fractional shares. Have you ever wanted to buy a blue-chip stock but found yourself short on cash? Are you skeptical of putting all of your capital into the stock of just one company? Do these doubts limit your ability to invest? Let's start with the basics. What exactly are fractional shares? Simply put, fractional shares are portions of a full share of stock. Instead of having to buy a whole share, which can sometimes be very expensive, you can buy a fraction of a share. This means you can invest in companies like Amazon or Tesla without needing thousands of dollars upfront. Who can purchase fractional shares? The good news is that fractional shares are accessible to nearly everyone. Many modern brokerage platforms offer the ability to buy fractional shares, making it easier for everyday investors to get a piece of their favorite companies. This is particularly beneficial for new investors or those with limited capital. How does the fractional shares system work? It's pretty straightforward. When you place an order to buy a fractional share, your brokerage combines your order with others to purchase a full share. This full share is then divided among the investors based on the amount of money each has invested. How are fractional shares created? Fractional shares are created in a few different ways. One common method is through stock splits. For example, if a company issues a 3-for-2 stock split, you might end up with 1.5 shares if you initially owned one share. Another way is through dividend reinvestment plans, DRIPs, where dividends are used to purchase more shares, possibly resulting in fractional shares. Finally, some brokerages specifically create fractional shares to meet the demand from their customers. Why invest in fractional shares? Fractional shares offer a wide range of benefits, which include the following. 1. Fractional shares open avenues to a wider pool of investments. Earlier, investors with limited money were limited to buying only penny stocks. But with the concept of fractional shares gaining popularity, investors can now purchase shares of a wide category of companies. Fractional shares have facilitated the shift of decision-making from the number of shares to be bought, to investing on the basis of available cash. 2. Fractional shares enable portfolio diversification at lower costs. Investors can use their limited cash supply to buy stocks of different companies in varied businesses and industries. Fractional shares enable smaller investors to create a diversified portfolio with limited resources. 3. Fractional shares enable investment flexibility. Investors are bothered to set aside money to purchase a full share in one go. With fractional shares, investors are allowed to buy in fractions as and when their liquidity permits. Fractional shares are especially feasible for new investors. Since fractional shares don't require investing a substantial amount, the risks are relatively low. New investors can benefit and invest in fractional shares to maximize their portfolio returns. But, like any investment, fractional shares come with their own set of risks. 1. Fractional shares cause share prices to inflate. Fractional shares allow retail investors to buy shares in portions or slices, which cause the price of already expensive stocks to inflate. It is a poor investment decision to invest in stocks of companies with inflated share prices. 2. Diversification risks. Fractional shares facilitate low-cost portfolio diversification. However, if the investors focus on low costs and make uninformed fractional purchases, they could get exposed to investment risks and suffer losses. Buying partial shares in individual companies is riskier than mutual funds or index funds. 3. Fractional shares are difficult to trade. Sometimes, the time taken to process the trade on fractional shares is much higher than that of the ordinary full shares. Complications arise in assessing the tax implications of fractional investments. This concept is already prevalent in the United States, and several Indian investors own fractional shares of tech majors such as Meta and Alphabet. While fractional shares are not yet a mainstream feature of the Indian stock market, the introduction of fractional shares in India has the potential to democratize investing, making it easier for retail investors to participate in the stock market. With growing interest and technological advancements, it is likely that SEBI and Indian brokerages will eventually create a conducive environment for fractional share trading. Until then, Indian investors can explore fractional share offerings through international platforms that provide access to global markets. If the SEBI proposal gets approved by the government, it would let people with limited capital invest in shares of high-value firms, thereby rendering the stock market more accessible. Investors who do not have the means to buy a whole share of a company will be able to own a fraction of a share and become a stakeholder. To sum it all up, fractional shares are a fantastic tool for investors of all levels. They make it easier to diversify, access high-price stocks, and invest with smaller amounts of money. However, it's crucial to understand the potential risks and choose a brokerage that meets your needs. That's all for today's video. If you found this information helpful, make sure to give us a thumbs up and subscribe to Goodwill Wealth Management for more investing tips and insights. Have you tried investing in fractional shares? Let us know your experiences in the comments below. Thanks for watching, and happy investing! Don't forget to check out our other videos and follow us on social media for the latest updates. See you next time. Until next time, stay savvy, investors!